Okay, well, with that in mind, let's get into Dean Orrico's Pro Picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer. It offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, your first pick is Canadian Apartment REIT. It's down over the last year. What's the opportunity? What's the exposure you're getting?
So this is, as the name suggests, an apartment REIT, which is by far the largest one in Canada. I know the management team well. It's extremely well run. So I've got no concerns about how it's run. And then over the last 2 to 3 years, it's embarked on a strategy to basically dispose of older assets and add newer assets that are not subject to rent control because they're built after 2018. And in addition to that, they're also selling non-core assets like their manufactured homes portfolio, which they sold last year to TPG, and some of their European ERES portfolio. So the balance sheet's getting stronger by the day, but the stock is trading at such low valuation. So here's a good example, Amber, of a REIT that's been around for 25 plus years, historically traded at a 5 to 10% premium to NAV. Today trades at about a 15 to 20% discount to NAV.
Okay, is that because occupancy has been falling and it doesn't look like that's falling, I should say. Occupancy has been falling and it doesn't look like that's inflecting just yet. And there's pressure on rents. They are offering incentives, to try and fill that declining occupancy.
Generally speaking, occupancy is actually held in pretty well at Cap REIT, so I've got no concerns about it. The average rent on a Cap REIT unit is about $1,500 a month. So what's really been a challenge for them is this point I mentioned earlier on turnover. So they typically had turnover about 20% of their units every year. People would leave. A new tenant comes in and they can move the move rent up to market levels. But because market rents are so much higher than the current rent being paid, people aren't leaving. They're now down to the low double digits turnovers. So that hits cash flow. What does that mean? Is that over time, that's going to be realized. So it's not happening as soon as we would have liked, but it's going to happen over time. And then I think the other reasons why it's traded off is that you've got concerns about immigration, you've got concerns about tariffs, you have all these issues that is primarily affecting foreign investors. We can't underestimate how important it is for a smaller market like Canada's to have foreign investors come in. And in Q3 and Q4 last year, there was this massive sucking sound out of Canadian equities and Canadian REITs. At some point, they're going to come back because the valuation disparity is too significant. The tariff issue will come and go. And I think U.S. investors and foreign investors generally are going to start coming back to these REITs. Cap REIT is the biggest. What do they typically do? They move to the biggest ones first where they have the most liquidity and can buy stock.
So can you do the math for us? If it's trading at a 15% discount, it historically trades at a premium, what kind of upside?
I think you could get somewhere in that kind of 25% upside over time, if not more, because I think this stock is probably worth closer to about $60, $65 a unit, and it's trading at, high 30s, low 40s.
Your second pick here is Granite REIT. I own this one for disclosure, and I've owned it for a long time, so it's been good to me. But it too has kind of pulled back. Granite is interesting because it started with Magna origins, right? But it's not just that anymore. Talk to me about the exposure you're getting there.
So Kevin Gorey, really good CEO. He was running with his team the Pure Industrial REIT that sold to Blackstone. Then he came over to Granite. And at the time, you're right, it was primarily, or a significant number of their leases with Magna. Magna's now down to like 25% of their total portfolio. They've done a great job diversifying away from Magna, having a much broader tenant base. So what's hit it very hard in the last few years is that, during this period where e-commerce was growing and there was more demand for logistics and industrial properties, they started to build properties primarily in the US and started to build them on spec. And then, like a lot of areas, they built too many properties, as did their competitors, and now leasing up those new properties has been a challenge. The good news is that the amount of new supply is rolling over, so you're not getting many new properties come up. I think it's peaking late last year, this year. So as a result, the leverage comes back to the landlord, and they're now finally starting to sign some leases. Not as many as we would have liked, but again, when I look at a company like Granite trading in the high 60s, where I think, this stock could be an $80 to $90 stock over time, it's incredible value with one of the best players in the space.
How much of a risk is that Magna exposure still? Because it is really in the eye of the tariff storm, and 25% is still really high exposure to a single tenant.
Great question. So at the end of the day, what does Magna mean to Granite? They've got long-term leases with an excellent credit. So while Magna may have some issues with tariffs, because it could be disruptive to the whole automotive supply chain, at the end of the day, Magna is an excellent credit. They're going to continue to pay their rent. And that's really what Granite is concerned about. So I don't have any issues with Magna at 25% of Granite's portfolio.
Your third pick is RioCan. So this one is your retail exposure. What do you think of this? What's the sort of long-term play with RioCan?
Excellent. Think about retail, and they're primarily, necessity-based, grocery-anchored shopping centers, not enclosed malls. They have some, but it's a very, very modest part of the portfolio. So, like a lot of real estate sectors, you haven't had much new supply. What have the shopping center players been doing? They've been taking their parking lots and putting up condominiums and self-storage and all that type of stuff. They haven't really added more retail over time. Meanwhile, major grocers like Loblaws and Metro and Sobeys are looking for more retail. Now, they typically are the anchor in one of these shopping centers. If RioCan has a space that might have been vacated by a Target or a Toys R Us, that would be normally a smaller footprint, those grocers are taking that space as well. So again, you've got limited amounts of supply. You've got very strong demand. We just saw Loblaws reported excellent numbers. Loblaws is a major tenant of RioCan. So from that perspective, they're seeing increasing rents because supply and demand is imbalanced.
Give me, what do you think the upside is here? What's the discount? What's the opportunity?
So that stock now trades at about $20. It's had a nice move on printing a very good quarter just a few days ago. This could be a $25 stock over the course of 2025. So again, you've got really good upside from here if it just goes back to historical multiples.
Now, I want to ask about RioCan because I feel like it's one of those stocks over my career. Everybody has lovely things to say about it, but the stock itself, over the long term, it struggles. It's not back to even where it was, say a decade ago. So it's not like we're just using the pandemic as its peak. Having said that, over the last couple of years, you can get 80% moves, you can get 30% moves. Is it more of a trading stock? Like, I know people don't talk about it that way, but do you have to look at RioCan as more of a trading stock? It's
a valid point. I think trying to time your entries and exits, if you chose to trade RioCan, I think it'd be very difficult to do. It's the largest retail player. Choice would be very large as well. So from that perspective, you can get liquidity. So you could trade it if you chose to. That stock's been as high as the high 20s, low 30s, if I look back 10 years or so. And the other headwind for RioCan in the past few years is that, like a lot of the retail REITs, they see they've got these parking lots. They see they've got a shortage of housing in Canada. They've been building, apartments and condominiums. There was lots of concern with RioCan that a lot of these condos that they took a deposit on 3 years ago, 4 years ago, were coming due for closing. And there's been lots in the news about people not being able to close because rates have gone higher. They just reported that 98% of those condos actually closed. So they actually got the proceeds for building and selling those condos. That was really positive. They're building up and have built up a whole nother division within the REIT called RioCan Living that at some point I think probably gets sold or IPO'd or whatever the case may be. So I think there's some hidden value in that. So these are some of the things over time that I think will play out, which will drive the stock higher.
All right. Thank you so much, Dean. It's been an absolute pleasure. Thanks for joining me in studio.